Remember when house prices never go down? In the 2000s, we turned that myth into a financial Jenga tower. Then one block slipped, and the whole thing crashed. Today, we'll rebuild the tower, one honest piece at a time. Hey, it's Sketch Figures. Finance, sketch simply. Tap like, subscribe if you want smart money stories without the snooze. Stay to the end for a quick checklist to crash-proof your personal finances. In the early 2000s, interest rates were low and mortgages were easy. House prices didn't walk up, they sprinted. The Case-Shiller National Index, which is set to 100 in January 2000, climbed to roughly the 100s and 80s by 2006, about 80% higher than 2000 levels. That's not normal. It's a bubble. Cheap money plus looser lending standards equals more buyers chasing the same homes. Lenders increasingly approved no-doc and subprime loans, loans to riskier borrowers, then sold those loans to Wall Street. Risk was sliced, diced, and shipped to investors like a pre-packed fruit tray. Looks neat, hides the brown spots. A borrower with shaky income gets a mortgage with a low teaser rate for 2 years. The bank sells that mortgage into a pool. As long as home prices rise, everyone feels brilliant. Not every market boomed or busted the same way. Some cities saw modest gains, and not all subprime loans were fraudulent. Many borrowers paid on time for years. Still, nationally, the surge and later drop were historic. A bubble is just a story with numbers attached. When the story changes, the numbers follow. Meet the star villain, the CDO, or Collateralized Debt Obligation, a bundle of debts, like mortgages, repackaged into slices called tranches. Think of a layered cake. The top slice gets paid first, safer. The bottom slice gets paid last, riskier. Banks pooled mortgage bonds and created tranches with different risk-return levels. Ratings agencies often stamped many top slices AAA, the same as U.S. Treasury debt, because historical models assumed home prices rarely fall together. Then came synthetic CDOs, bets on those bonds using credit default swaps. That multiplied exposure without needing new actual mortgages, like photocopying the same risky sandwich over and over. When the meat spoils, every copy stinks. The IMF showed how even mezzanine CDOs were stacked with a high share of AAA-labeled tranches. Great on paper, fragile in real life. A CDO isn't automatically evil, it's a tool. When backed by diversified, well-underwritten loans and transparent data, it can work. In the 2000s, speed, leverage, and incentives broke that balance. Complex wrappers don't delete risk, they just move it, and sometimes multiply it. By 2007, mortgage delinquencies were rising. In September 2008, fear turned to panic. On September 15th, Lehman Brothers filed the largest bankruptcy in U.S. history. That same weekend, Merrill Lynch sold itself to Bank of America. Markets froze. Modern finance runs on short-term funding, like breathing through a straw. If lenders won't roll your overnight loans, you suffocate. After Lehman fell, everyone clutched their cash. AIG, the insurer that wrote mountains of swaps tied to mortgage bonds, couldn't meet collateral calls. On September 16th, the Federal Reserve offered AIG up to $85 billion at steep rates to prevent a domino collapse. Some argue Lehman's failure was necessary to curb moral hazard, the idea that rescue expectations encourage risky behavior. Others say letting it fail turned a bad fire into a wildfire. Even official timelines show the cascade that followed. In crises, confidence is oxygen. Lose it, and even giants gasp. If this breakdown is clicking so far, tap like and subscribe. It helps more people find clear explanations. With credit markets seizing, Congress passed the Emergency Economic Stabilization Act in October 2008, creating TARP, the Troubled Asset Relief Program. Headlines screamed $700 billion. In reality, that was the authorized ceiling, later cut to $475 billion by Dodd-Frank. Instead of buying toxic assets directly, Treasury quickly pivoted to inject capital into banks by buying preferred shares. Think of it as a financial blood transfusion to stabilize the patient first, then deal with the infection. Treasury committed approximately $250 billion to stabilize banking institutions and also supported AIG, autos, and credit markets. Later, most funds were repaid. Independent scorekeepers estimate the net cost landed far below $700 billion. CBO's 2012 estimate was about $24 billion, and GAO later put lifetime cost at approximately $31 billion after repayments and earnings. That's still real money, but not the headline number. Net cost counts dollars in, out, not the broader economic pain or the precedent it set. Critics argue it reinforced too big to fail and favored creditors over homeowners. Oversight bodies raised transparency and moral hazard concerns. The bailout was less a blank check and more an expensive tourniquet, effective, messy, and controversial. After the savings and loan crisis in the 1980s, hundreds of insiders were convicted. After 2008, far fewer senior executives saw criminal charges. One notable conviction was at Credit Suisse, Kareem Sarageldin. Most big outcomes were civil settlements costing banks billions. Criminal cases require proof beyond a reasonable doubt of individual intent. Complex products, dispersed decision-making, and it-was-in-the-model defenses made that hard. The DOJ leaned on civil tools, like FIRREA and the False Claims Act, to extract large settlements. The Bank of America settlement alone was $16.65 billion, a record at the time, covering conduct at BofA, Merrill Lynch, and countrywide. But a check is not handcuffs. Some journalists and scholars argue prosecutors became risk-averse after high-profile trial losses. Others note data tracking problems even overstated mortgage fraud wins 1 year. Meanwhile, critics of the "nobody went to jail" line point out there were convictions, just not many at the very top. The overall picture: lots of civil penalties, relatively few executive convictions. The legal system punished institutions more than individuals, raising fairness and incentive questions that still linger. Crises rhyme, the characters change, the plot points repeat. Easy money, new products, rising confidence, hidden leverage, sudden stop. When risk spreads through the system, small sparks become big fires. That's why we got reforms after 2008, like Dodd-Frank, stress tests, and higher capital, and why regulators watch derivatives and funding risks more closely now. But risk doesn't vanish, it relocates, often outside banks. House prices and credit cycles still move. Delinquency data and home price indices remain key dashboards. Keep an eye on the Case-Shiller Index and mortgage delinquency trends. They're the smoke detectors for housing heat. New safeguards help, but no regulation can outlaw human optimism. Behavioral finance reminder: loss aversion, we hate losses more than we like gains, can push us to hold falling assets too long, or to avoid sensible risk entirely. Morgan Housel puts it simply: behavior beats math. Now here's a mini takeaway, one practical move from this video that will help you build your personal shock absorbers for your finances. Emergency fund, cash you can use fast equals liquidity. Avoid concentrated bets you don't fully understand. Fix your rate on big debts when possible so rising rates don't surprise you. Education only, not advice. The 2008 financial crisis shows how housing myths, complex products, and fragile funding can break the system, and why buffers matter. Quick rewind. Prices surged on easy credit, Wall Street sliced mortgages into CDOs, and in September 2008, trust snapped. Lehman failed, AIG wobbled, and TARP arrived to halt the spiral. The cleanup punished firms more than people, leaving a debate that still burns. Today, this means watch the basics: debt levels, funding risks, and housing indicators, not just headlines. One practical move: keep a cash buffer and avoid leverage you can't carry in a storm. Mindset: don't outsource your skepticism. If a product needs a 20-page explainer to seem safe, it's probably not safe for you. If this helped, hit subscribe and the bell so you don't miss the next one. And if you haven't already, check out our last video on the dark history of short selling. This video is for education only and isn't financial advice.